Hi, in this video we will be looking at the next component in the calculation of cost of equity. The component is market risk premium. Let's see what is about risk premium. The CAPM formula is used for calculating the expected returns of an asset. It is based on the idea of systematic risk, otherwise known as non-diversifiable risk, that investors need to be compensated for in the form of risk premium, because the investors are taking a risk by investing their money in a particular company's stock, so for which the particular company has to compensate the risk which taken by the investors in the form of market risk premium. Risk premium is nothing but over and above the risk-free rate of return. The market risk premium is the additional return an investor will receive from holding a risky market portfolio instead of risk-free assets. The market risk premium is part of the capital asset pricing model, which analysts and investors use to calculate the acceptable rate of return for an investment. At the center of the CAPM is the concept of risk and reward. Investors always prefer to have a highest possible rate of return combined with the lowest possible volatility of returns. There are concepts used to determine market risk premium: required market risk premium, historical market risk premium, expected market risk premium. We'll see one by one. Required market risk premium: the minimum amount investors should accept if an investment's rate of return is lower than that of the required rate of return, then the investor will not invest. It's also called the hurdle rate of return. Hurdle rate of return is nothing but a minimum rate of return which is expected by the investors. Then the second one is historical market risk premium. The another method to determine market risk premium: a measurement of returns past investment performance taken from the investment instrument that is used to determine the premium. Historical premium will produce the same result for all investors, as the values calculations is based on the past performance, past data. Then the third determination is expected market risk premium, based on the investors' return expectations. Of course, the expectations will differ from person to person. I may expect 10% from the stock market, you may be expecting a 20% return from the stock market. So the required and expected market risk premium differ from investor to investor. During the calculations, the investors need to take the cost that it takes to acquire the investment into consideration. With an historical market risk premium, the return will differ depending on what instrument that the analyst uses. Most analysts use the S&P 500 as a benchmark for calculating past market performance in a market. Usually, a government bond yield is the instrument used to identify the risk-free rate of return, as it has a little to no risk. Market risk premium formula and calculations. Market risk premium is equal to expected rate of return minus risk-free rate. Example, the S&P 500 generated a return of 8%. This is a market return in the previous year, and the current interest rate of the treasury bill is 4%. Then the risk premium is 8 minus 4, that is 4%. Market risk premium is the answer. Thank you. These slides depicts the assessment part. Just go with this. what is market risk premium and how it is calculated in the kappa model. Thank you.